back to Trading 360. I'm Nicole Pinalides. It's time for the big three. Three stocks, three charts, three trades. Rick Ducat will take us through the charts. Here to take us through the trades, Aquiles Larrea, founder, CEO, Larrea Wealth Management. Great to see you both. Thank you for being here. Aquiles, a quick market thought?
Yeah, the market right now is doing exactly what I told you in December. It's going through a correction right now, corrective phase, taking everything back down with it, a regression to the mean of sorts. But more importantly right now, I think, is that you have an opportunity to pick up these new quality stocks. You know, I talked about some technology stocks, some AI stocks the last time I was here. You have a great opportunity to pick them up. Some of them had been riding high and fast. Now you can get them at a better pricing. And also the blue chips are moving very nicely as well, because people want this flight to quality. They want to get into these high quality stocks and stay there.
Right, understood. Okay, so in the meantime, we're taking a look at these names that are, as you said, we're watching for blue chips. You're watching for dividends. I guess you're staying away from some of the high flyers. Last time you were on, you talked about Kingsoft, KC. Maybe at the end we could take a peek at it. So here's Altria, which is up 1.3% today in the tobacco world, and it's hitting new highs recently. Some of your thoughts?
Yeah, it's not an accident that that's happening. When people see this type of volatility, this type of market calamity, they want to be in stuff that's stable, that has made them money over the years. Philip Morris is exactly that type of company. If you look at the 6+% dividend on it, along with the growth that occurs when a flight to quality happens, fund managers, hedge fund managers, all going into Philip Morris for the moment. They might this just might be a quick trade to them, but they're going to pick up 1 to 5% in an era of calamity, in this very short-term volatility that's happening right now. So you want to make sure that you, like the experts, like the big guys, are getting in there and taking your piece of the dividend pie and growth pie that is Philip Morris. We're looking for them to make anywhere between 6 to 8% conservatively this year. That may or may not include the dividend that's currently paid out. I believe they're closer to 7 right now. But the thing to remember with Philip Morris is you're not going to have that type of volatility, and that gives both fund managers and investors pause to say, hey, you know what? I can pick this up, have it for a certain amount of time, and move forward with it. We're also looking that Philip Morris has some new prospective areas of income coming into the company, and that's going to be very interesting going forward.
Yeah, okay. Let's see what Rick Ducat says about the charts. Rick, take a look at MO for us, please.
Yes, a pretty nice move to the upside here. And an interesting chart as well to digest for our technical purposes here. You can see that we had this longer-term trend line beginning with these 52-week lows, connecting our subsequent lows here. We had a bit of a breakdown in this area, and then things get a little more muddy. But this, our trend line was about where we opened once again, and then it's proven to be potentially resistance here. That's about where we topped out recently. So these old trend lines can come back into focus in ways that you might not expect sometimes. However, notice as well that it could just be a coincidence, because we do have this old series of double top highs here. 57.74 was our best close. Once again, we didn't really manage to make a strong close beyond that level for now here. So this is 58 or so, clearly the level to watch to the upside for signs of a further breakout. We can see RSI as well having a little bit of a problem here in terms of bearish divergence. Price is making a higher close, or on pace for it at least. RSI is not making a corresponding higher high. So perhaps a potential short-term thing to consider there as we move forward. If we were to look at our standard deviation channels and our volume profile study, we can see that our standard deviation channel, our +1 channel, comes in up here near about 61 or so. So that's one standard deviation above our blue linear regression line. So that would be a potential resistance point to consider. Our linear regression line itself lines up with our volume node near about 56.50. So providing us with a convenient downside point to watch for support, Nicole.
And sometimes, thank you for that. I appreciate it. I see the resistance. And sometimes people think of this as more of a defensive play. The company did reaffirm its full year guidance for 2025. It's been an incredible performer over 1 year, up 45%. Year to date, already up 11%, while so much of the market has been down. Really has been shining. It's at 57.76 today. Where do you think this can go to? Are you looking at the highs of 58 or 60 or 65?
I don't think it's out of the question. I think it's going to be some time before we get to that. I'm probably thinking about 18 months on that if we go that high. It's going to take some time. But this stock, again, high quality. People are going to keep coming into this stock when the volatility hits. And right now it's hitting really hard. So they're going to get into it. They're going to hold on, get some dividend, get that 7% out of it, and then they're going to bug out. I see that over and over with fund managers.
Okay, and then we take a look at RTX, which used to be Raytheon. Now it's RTX Corporation after that combination. Also has been at a recent high, has pulled back a little bit off that high number. Aerospace and defense, another safe player, I guess?
Yeah, of sorts. You know, we talk about the Pentagon spending less, but the core industries of Raytheon are going, you know, you have Otis Elevators, you have Carrier, all these names are still high quality names that domestically they're spending money on. We're always going to spend money on air conditioning, we're always going to spend money on maintenance. But the thing to remember with Raytheon, decent dividend, not as high as Philip Morris, around 2-3% or so, but great growth potential. Once again, the fund managers, hedge fund managers, will go into a stock like this at a short period of time, get what they can out of it, get some movement on the upside. We think it's a 9 to 14% move on the upside. We've seen it before with this stock. We think it's very transparent in terms of the money that they're making going forward. We also don't think it's much ado about nothing. It's not the same old with Raytheon. They are going into many different industries and making excellent money in each one.
Okay, let's see what we have, because he thinks there could be 9 to 12% upside, Achilles does. Rick, your thoughts on the chart here?
A move to the upside after a rather protracted sideways period after earnings. So we had our gap up, and then we had a bit of a rally here, but eventually we struggled to make our way convincingly beyond those lows that we established shortly after that gap up. So around 114 was the supportive area. Now you could argue that we have our longer term upward sloping trend line to connect these two lows. That would give us a supportive point to watch if things start to deteriorate, but that's pretty far off at this point. In the nearer term, this is the area of interest. Our green line here, that represents the low point after we had a small gap up, and that's about where we held the line recently during a couple of declines. We also held on at this area, which was happening to overlap with the orange 63-day exponential moving average. So a support confluence there near about 122.50 that we have held multiple times here and gives us a place to watch going forward. RSI compressing in a triangular shape here, an increasingly narrowing set of boundaries for our momentum indicator, which is also on the verge of crossing below that 50 midline as we are testing the support of our short-term trend line. So watch for those two things to happen in tandem, corresponding downside breakouts for clues to further directionality. If we were to include our other studies once again here, we can see that the volume node that is closest to us, pretty close to these supportive areas that I mentioned, right around 126 is a heavy trading area. Beyond that, another one near about 118. To the upside, if we were to take out those old highs that we carved out near 135, the +1 channel comes in near 140, our +1 standard deviation channel there. So that could be another area to keep in mind going forward if we may break above those highs.
Okay. Final thoughts on this name, and then we'll get to Caterpillar.
Yeah, this, once again, going back to what Rick was talking about, it has shaken out a lot of itself. And we're going to see same with Caterpillar. A lot of shakeout occurred here as with the market, but there's tons of opportunity. Pick up this stock, high quality, whether it goes up in the near term or up in that long 18-month time frame, should see a nice movement to the upside, and you'll be rewarded for your patience.
All right. Well, Wolf Research not that long ago on the 27th put an outperform rating on Caterpillar, has a 390 target. It's at 344, so they see some upside. That's one of the latest analyst calls. You like this one, right?
Yeah, we've talked about it before. Caterpillar has been one of these stocks. It was acting like a growth stock at one point, and then it came back down to earth. And it came that was a precipitous drop that occurred. Now what we see is that, okay, it came down and starting to come back. Here's your opportunity for an entryway that you're going to get into this stock. Dividend is not too much to speak of, about 2% or so, but let's talk about the growth opportunity. Just take a look at the last 2 years that have occurred with this. There's plenty of opportunity here. It's not like your Home Depots of the world that are going to be really hit by the upcoming tariffs, but there's still opportunity with Caterpillar to make more money, and we're looking to make close to double-digit returns in the long term, going out 12 to 18 months.
Okay. What do you think here, Rick?
From a technical perspective, I think this was perhaps the most difficult chart to give a read on here because we've had such large swings recently here with some notable gaps. So to break it down, though, you can see that we failed to take out our 52-week highs previously, 418.50 during our last rally. Then earnings provided a further downside catalyst. Now we're below all three of our moving averages. Our faster moving averages are starting to cross below our slower ones, which is a sign of potential trend acceleration to the downside here. Today, we are trying to test our yellow 21-day exponential moving average near about 348, but so far it hasn't panned out for the bulls. One thing to consider, though, is that we are breaking above our short-term downward sloping trend line that began with our post-gap down highs after earnings. So that could be a bright spot here. RSI is also experiencing a corresponding breakout. So like I was saying for our last chart here, you would look for these things to be happening in conjunction with each other. That lends further credence to this potential upside move here. So it's also noteworthy that we held on at these previous lows back here. We did make some intraday lows beyond them. But in terms of closing prices, we held on pretty cleanly near about 326. So once again, incorporating our other studies here, we can see that this is the kind of chart that stands out to a lot of people because we are near a significant support area. We've got our volume profile point of control, our area of heaviest trading, our old lows, and our -2 standard deviation channel all coming together around that 329, 330 level, and we bounce. So heavy volume at a low point after a big decline is typically viewed often as a sign that a bottom could be in. Not saying that's going to happen or anything, just that's the way a lot of people would kind of choose to digest that information, Nicole.
Okay. It's great to see you, Rick Ducat. Thank you for those charts. And Rick, you may remember maybe, I don't know, a few weeks ago you were on Achilles and you talked about Kingsoft, a name we never really talked about. Then it became very popular, had a 20% move maybe a day or two after you came on and recommended it. It has since been very volatile. Do you still like Kingsoft today at $17?
Yeah, absolutely. It reminds me of Palantir. Palantir has suffered significant moves to the downside in its trend upward, and we saw how that turned out. Right now, it's still facing a little challenges, but Kingsoft is a similar story where they have this data storage technology. They're doing really well. The only thing you have to watch out is that it's super volatile. You're not going to put more than 3 to 4% of your total portfolio into it. If you do, you know, this is risk capital. This is the market. This is not for the weak. I still believe in the name.
All right. Good to see you, Aquiles Larrea, and thanks for circling back on that name. Our viewers want to know. They need their actionable advice. Aquiles Larrea of Larrea Wealth Management, our own Rick Ducat there on the charts. Thank you both so very much. We looked at Altria, Raytheon, RTX, Caterpillar, and Kingsoft. Thanks.